Today we're going to talk about short selling stocks. Now, if you don't know what short selling is, it's essentially borrowing a stock and then selling it with hopes that the stock will fall. Then you could buy it back at a lower price. Think of it as a form of arbitrage. Think of it as selling me a car and then buying the car back from me after it's depreciated in value. Because you know that cars definitely depreciate in value, you know it's a safe sell. But stocks are different because stocks, for the most part, go up. And that is what has been happening ever since the stock market started. But you have those years once in a while where the stock goes down. So why am I showing you this Google page here? Well, if you Google short selling, you're usually going to find people telling you not to sell short any stock because it's too risky. On the first page, yeah, it's mainly definitions, but eventually you'll see some here. Why you should never short sell stocks. So you're going to see a lot of anti-short selling stuff around the web. I've made this short selling tutorial for people who want to sell short stocks, and I'm going to first convince you that it's actually not a bad decision. Now, why do people say you shouldn't short sell stocks? Let's take a quick look. But I can tell you, first of all, it's against the American ideal. So as an American, as Americans, I'm not sure how many of you are Americans, but you probably have heard that people drive stock into the ground by short selling, and it's just un-American because what you're doing is you're taking advantage of a company that's falling, or you're just putting downward pressure on a stock. And that's the opposite of what most people do when they invest. When they invest, they put in money and they hope that the stock does well, because the company does well means the stock will also do well. Now, what short sellers are doing is they're hoping that the company does not do well, and that's just anti-American, right? Well, let's see. Most people say it's about greed. It's just about money. Okay, so this is good, I guess. That's not a very good article. It's not very long. But here's the general idea of why short selling is not bad and actually is good for the economy. When you sell short a stock, you do put downward pressure on a stock, and more people doing that puts more downward pressure on a stock. What that does is suppresses bubbles. It keeps stock from being overvalued. Now, here's something you probably didn't know. Almost every stock in the stock market is overvalued. Let's go to stock charts. Let's go to Yahoo. Almost every stock is overvalued for a couple reasons. First of all, we've been in a bull market for the past 7 years or so. And these past 7 years has brought even bad stocks like Yahoo way up. You could do this for pretty much any stock, but if you want to look at the stock market as a whole, you use an ETF, which tracks the stock market, like SPY. This tracks the S&P 500. You can see the stock market has continually gone up. QQQ, which tracks the NASDAQ, has continually gone up for the past 7 years. And even if you go back, way back, you'll see that it has done so ever since the crash, and now we're back where we were before the internet crash. Now, a lot of this downward movement was because of short sellers after the internet crash, but a lot of it was actually fair. Now, if you're going to sell short, you rarely get these opportunities where you're in a short market and you can short ETFs, but sometimes you do. And in those situations, you're very lucky. Those come about once every 7 years. So here's one in 2000, and then there was another one in 2008 that you probably remember quite well. Overall, what you're looking at when you do short selling is you're looking for opportunities to sell stocks when they are overpriced. And like I said, most stocks are overpriced for a couple reasons, several reasons actually. One is investor sentiment. Most long-term investors will buy with a time frame of about 1 year. So they're looking at the company's 1 year future situation, and they might be looking at fundamentals like balance sheets and that kind of stuff. But when you sell short, you should have a longer time frame. You should have a perhaps 5-year time frame and hold your position longer. Now, the problem with this is you need a margin account to do so. To short stock, you need a margin account, and you can get that with your brokerage account now, but with a margin account, you're saying that you're going to borrow extra stuff from your brokerage, and you're going to take the risk of having to pay that back if the trade goes wrong. Now, that can be dangerous, and many people have had their accounts wiped out by the wrong short. Yours truly has also encountered such a situation, and to date, after right here, boom, nope, that's not it. I'm looking way too far back. This happened a couple years ago, actually last year. I believe I shorted the stock before this up gap, and it just kept going up, and I closed it out, and I lost a lot of money. I basically wiped my account off. I don't short stock anymore, so why am I giving you this short seller's tutorial? Because short selling is actually not just short selling. You've got three options for short selling. You can actually sell short stock, which means you borrow the stock and then sell it back, and then buy it back later, which is called buy to cover. That's the first option. Second option is sell call options. And your third choice is to buy puts. Now, they all do the same thing. They're all essentially trades looking at a bearish thesis. So if you believe something's going to go downward, you can do any of these and you'll profit. Now, if you're going to sell stock short, you need a lot of money, and you also need to have a long time frame, because most stocks are going to go up even if they shouldn't be going up, even if the company's a bad company. If you're going to sell call options, you also expose yourself to the short stock risk, so I would say don't do that. Over time, it's actually a good strategy, but if you're watching this tutorial, I'm assuming you're not so familiar with shorting stock, so avoid this for now. Now, the safest choice is to buy puts. If you have a margin account, you can also open an options account and you can buy puts, which is the safe way of shorting and is actually more profitable than selling short. The main difference between selling short stock and buying puts in terms of how you choose the stock is that when you sell short stock, you generally want a time frame of around 5 years. You're doing the opposite of what investors are doing. But when you buy puts, you can go with a very, very short time frame, even within a day. You could day trade downward on a stock. Now, I keep saying that most stocks are overvalued, and I hold that to be true for several reasons. First, investor sentiment, like I showed you, has been growing for the past 7 years or so. It just everything keeps going up, and that's not only because of sentiment, it's also because companies in the US these days don't know what to do with their money. So what they do is they initiate buyback programs. A buyback program is when you take the outstanding shares and buy them back and put them back inside your company, reducing the outstanding shares. So let's look at the outstanding shares for Netflix, for example. And it'll show you the trend. Now, if it's going up, that means shares are being diluted. What investors are holding on to, each share is now worth less of the percentage of the company than it was before. So Netflix obviously has not initiated a buyback program. So the rise and fall of Netflix is actually going, first of all, with the market upward because the market's going up, but it's also going against this share dilution. Now, if you look at another stock, let's switch to QCOM perhaps. All right, so QCOM has a downward trend in its outstanding shares. What that means is QCOM is buying back shares. Now, this is not a huge change, 1.7 billion to 1.5 billion. It's not a huge change. A huge change would be something like, I just wrote an article on it the other day. I remember there's a huge change in the outstanding shares. Was it IBM? I believe it was. I think this is it. So I actually ran this through a program and calculated the outstanding shares, and look, it has dropped in half in the past 10 years, which means that IBM as a company doesn't know what to do with its money, so it's paying it out to investors as dividends, and it's also buying back shares to make each share of the company, share of the stock, worth more of the company. Now, what this does is also inflates the stock price. So if you do look at IBM, it's going to go up for a couple of reasons. It's going to go up because the stock market's going up, and it's going to go up because outstanding shares are going down. Now, interestingly enough, IBM has been going down. So even with flowing with the river of the stock market and having the catalyst of stock growth that the buyback program brings, IBM has been falling. And that's mainly because it's just not that good of a company anymore. And I've shown a very good short strategy for IBM to be shorting the month before earnings reports. For quarter one and quarter two earnings reports, you can almost always make a profit that way. But overall, when you do a short on a stock, when you open a short, you're going to want to do a little bit of fundamental analysis, not just technical analysis. So what's a good place to do fundamental analysis? Seeking Alpha is a pretty good place. You can just type in your ticker up here, and it'll give you the latest news for that stock. You can read through these articles, you can read the news. It's really up to you, but you're going to want to do a little bit of training in technical analysis to know what to look for. I don't find earnings reports to be very useful. Balance sheets can give you data to run. If you have a program, you can run data to get interesting aspects on a stock, but that is a little beyond what I'm going to talk about today. Overall, you want to get a fundamental thesis as to how the company is going to do in the future. And a simple way to do that is to ask yourself this following question, and I use this as a rule of thumb for stocks that I want to hold on to a long time or short for a long time. And the question is this: does this company have a monopoly on anything in the market? Now, for IBM, the answer is no. IBM has a failing, I wouldn't say failing, but it's being phased out. They have a business where they're making money with data frames and all that stuff that they're outsourcing to clients, not outsourcing, that they're selling to their clients. Their clients were using their computing facilities, but IBM, after the new CEO took charge, has done a lot of things to cut costs, which has cut down on their customer service, which in turn has caused them to lose clients. Things like outsourcing their services to India instead of using US labor has hurt them. So IBM is a falling stock, and this is a stock that's worth shorting, especially into earnings. I've done a back test to find that if you short into earnings, you're going to be statistically likely to profit. Now, that's not true for most stocks, and before you make a decision, you're going to want to look at some technicals too. So you start with the fundamentals and you move into the technicals. And there are actually two things I look for when I'm looking at the technicals. Now, before we get into the technicals, let's step back once more and talk about the fundamentals. Now, I just said the question you need to ask yourself is, does this company do anything that's monopolizing a market? The answer for IBM is no, but there are many stocks that do market monopolies, do have monopolies on a certain niche. And I just want to get a quick list of stuff. Like Netflix would be a monopoly. They have a monopoly on streaming at the moment. There's no one really competing with them that's actually making success. Just like Google has a monopoly on the search engine, nobody really searches with Yahoo or Bing, which are the same thing nowadays. So yeah, there might be some competitors, but honestly, if there's no big competitors, then it's not a good short idea, because that's a company that's going to do well in the following 5 years, provided there's no new competitors. So Baidu is another one of those. Baidu is like the Google of China. This is not a stock I would want to short. Another monopoly would be Tesla. They have the monopoly on environment-friendly cars, Tesla. But then you have the majority of the stocks do not have monopolies. For example, Citigroup, they're just a bank. they are going to fight with Bank of America, who in turn are going to fight with Goldman Sachs and fight with JP Morgan. These are all banks that are competing against each other. They're competing against one another, but none of them have a monopoly on a market. So these are decent opportunities for shorting. Now, right now, the banks are probably going to be doing pretty well in 2016, so I'd stay away from them. We've had to drop off for a strange reason. These days, it seems like bad news is good news and vice versa. The stock market is reacting negatively to good news and positively to bad news. For example, the recent negative interest rates that the Bank of Japan has taken up made the market go up. So dropping interest rates is good for Wall Street, even though it shouldn't be. And things like good news about the economy have seemed to drop the stock market for weird reasons. In that case, you really do want to follow the market as a whole, and you can follow the market as a whole with ETFs like QQQ, SPY, all that stuff. But for now, when you choose a stock to short or to buy a put option on, your general idea is to go through the fundamental analysis, see if this company is going to be doing well 5 years in the future based on that one question. Do they have a monopoly on something? And if they do, don't short them. It's a dangerous short. Or don't buy puts on them. Find something else. Find something that you know is going to go down and is overvalued. Excuse me. So if it's overvalued, like I believe Qualcomm is overvalued. I believe QCOM and IBM are both overvalued. So these would be stocks to short. Now, when you have gaps, I would say go back to my gap game plan and play those as short-term plays. Stay away from shorting stocks with recent price gaps between their candlesticks. So let's go back to IBM. They also have a gap. Don't short them. I would actually be long on. I am long on IBM at the moment because of this gap. Actually, because of this gap. But eventually, you're going to find something that the fundamentals show is not good. Bank of America is going to be pretty good in 2016. So stay away from that. But eventually, you're going to find some bad stocks. Why don't I just go? We'll just go to market news and we'll find something we're shorting, and then I'll show you the technical analysis here. Okay, so with the price of oil, airline stocks are going to do pretty well, but overall, airline stocks, they don't have a monopoly on anything. Like American Airlines is competing with 10 other airlines, so there's no monopoly. This in general is a good short, and we don't have any gaps here. Airline stocks probably going to do well in 2016 because of the low price of oil, so I'm going to stay away from them. Facebook has a monopoly on social media, especially in many countries. Let's see. Well, China's not going to do so well. All right, China's stocks are overvalued at the moment. FXI is an ETF for China. But because I want to show you something about individual stocks, we're not going to choose that. We're going to choose an individual stock. Why don't we just go ahead and choose why don't we choose a commodity? Something. Yeah, let's choose Exxon, all right? So ZOM, that's Exxon. They make oil, they sell oil. And oil is at a low price, and this company doesn't really have a monopoly on oil. So what are we going to look at in the technicals? Well, before we get to the technicals, we're going to look at one extra thing. You're going to type in the ticker, and you're going to type short interest. Now, short interest is going to be a list of numbers, and it usually will come out every couple weeks for free online, like here. But if you really want to swing trade and day trade with puts, and you want to make sure that you're buying the correct puts, you might want to subscribe to a service that gives you the daily updates. In my case, I don't really care that much because I'm swing trading, but here's what you want to look at: the so-called short interest. Now, what is short interest? Short interest, think of it as the amount of people wanting to borrow this stock so that they can sell it immediately and then buy it back later. Now this grows and falls as time goes on. So as you can see, it had a low around May, and short interest has gone up as the price of oil has gone down. Now 1015, let's see here, 1015, that short interest, because of this one candlestick, or 1015 is showing backwards. Let's see, 1015. That's the settlement date. So because we only have 2 weeks, each data point is for 2 weeks, we don't really know. But what happened was probably a so-called short squeeze, and I'll talk about that in a minute. The short interest died out because people didn't want to borrow the stock when it was going up, but when it started to fall, short interest rose. Now, if short interest rises, if you see it rising, generally that's a good sign that people are willing to short the stock, and that's putting downward pressure on the company. You want to be in a short position when the short interest is rising. So right now it's rising, but it looks like it's more or less around the same area, so nothing has changed much. If you did see it perhaps at this time, 45, 51, 54, that's rising, and that would give you an indication that it's probably time to look into shorting ZOM. Now you don't want to look at this alone. You want to use the fundamentals to pick your stock, and you also want to look at the short interest, but after that you want to go and look at the technicals. So let's just look at what happened at 12.15. Was that worth shorting? Well, 12.15 was around here, and yeah, if you shorted it, you could have made money. Not a lot, but it went down. It certainly went down. Now, what are you going to look at once you get your chart? There are two indicators I want to use for short trading. The first one is already there. It's RSI, and the second one is the slow stochastics. The first one, RSI at the top, we care about the trends. We care if it's going up or down. Now, if you want to short stock, you generally want to short it when RSI is rising. Okay, when it's rising. Some people use RSI to determine whether a stock is overbought or oversold. I don't like to use RSI. I prefer to use the stochastics to determine whether it's overbought or oversold. But the RSI is helpful because if RSI is rising, that's correlated with a coming fall in the stock. Now, my entry point is determined by the slow stochastics. So what I want to look for is the dual indicators of a rising RSI and a slow stochastics that's above the 80 level. All right, so anywhere up here I would say would be worth shorting, but I'd want to do it when the RSI is on the rise. So while it's on the rise here, this is where I would have shorted. Now it would be a bit scary because the stock did rise ultimately to 86, but as you can see, if you hold on to that short for a longer time period, it's going to fall down. The RSI rises, the slow stochastics are in the overbought region, and eventually it's going to fall out. Once it falls out, when do you close, when you buy to cover? Well, you can either have a take profit, you can reach a certain target and then buy to cover, or you can look at indicators, and I just do it backwards. If RSI is falling and it falls below the 50 line, or if the stochastics fall below 20 and then start to turn upward, that's when I get scared, and that's when I will sell my put option. Like I said, I don't really short anymore, but that's when you'd want to buy to cover. So that would be the situation on ZOM. Are there any shorts that I have done recently? I think DRN was a short that played out for me. I forget when I did it. Let's just assume it's here, okay? So I didn't short, I bought a put option. Now, RSI had been rising since here, and I believe, yeah, it got into the above 80 region. And at that time, you just short. Now, remember, we're not using these technical indicators alone. We're also looking at short interest, and we're also reading the fundamentals. DRN is actually an ETF. It tracks the real estate market. I thought the real estate market was not going to do so well after the interest rates were hiked by the the Fed after the FOMC meetings. Why is that so hard for me to say? So the Fed hiked the interest rates, which is essentially the rate that they allow loans from their bank to other banks. And if that rises, generally mortgage rates rise, and that hurts the real estate market. So in that situation, we've got our fundamentals. We've already screened DRN as a likely short. It's a 3 times leveraged ETF, and in that case, it's going to move a lot more quickly than the market really should. But that's good if you're buying puts, and it's also good if you're shorting and you're very, very confident in the short. But if you're buying puts, it means you can move a lot and you can make quite a bit of money just based on that. Okay, so let's review. I recommend buying puts over just straight out selling short stock. Of course, you can sell stock short. Many people do. The only disadvantage, in my opinion, the only disadvantage of buying puts over selling short stock is that puts have an expiration date, and if you don't sell quickly enough, you could lose money. Now, shorting stock actually has interest that you have to pay, but it's going to be generally less than the time decay that you have in buying a put. Overall, I think it's a lot safer to buy puts. If you're interested in buying puts, see my other video on how to buy puts. But everything else holds the same. Do your fundamental analysis, figure out a stock or an ETF that you think is overvalued and will probably fall. If you're swing trading, you can just look out the industry and possibly news. If you are going to be doing the opposite of investing and holding it for a while, you're going to want to do a lot more fundamental analysis. But after that, look at short interest. If it's on the rise, you've probably got a good short on your hands, and then check your entry point. Your entry point is when the RSI is rising and when the stochastics are above this 80 line. And that's enough to make a decision to short a stock. And in general, over time, you are going to be statistically likely to profit through this method. Now you've joined the dark side of trading, and investors are going to say you're not adding anything to the market. And when they say that, just show them that picture of the QQQs way back during the internet crash and say, actually, you guys were the ones not helping. Do we have that? You guys were the ones not helping, pumping up all of these internet stocks that weren't making any money at that time, and then causing the market to crash. The short sellers were the ones who came out on the good end of that deal, and short sellers are still helping people today, and they're still making a lot of money today. It's probably the easiest but slowest way to get rich, but if you want to do it, there are risks associated with it, so I highly recommend you use put options and call options as part of a hedge trading strategy instead of just being one way on the market. I never recommend being always long or being always short unless you're going to hold that for a very, very short time, unless all of your positions are swing trades or day trades. But shorting is not something to be scared of. It's something you should add to your trading strategy, to your portfolio, to your tools, whatever you do, whether you're a swing trader or investor. Shorting stock is going to be a useful tool in the upcoming bear market that will come. It'll eventually come. That's a fact. Bear markets always come. And if you're on the long side, then all you're going to be doing is scrambling to make sure you don't lose your money. But if you're like a what is it called? A ambidextrous hitter, you can swing up and down just along the market trends, and you will be profitable in the end. This video has gone a lot longer than I wanted it to. Last thing I want to say is please subscribe, and I will know that you guys are liking these videos, and I'll make more. Also, like the video, please. And please, at the very bottom, where there are comments, ask me to make a video for a certain topic, and I will. I'm running out of ideas. I need your input to come up with new ideas for videos so I can keep this channel alive. Thank you.